We have all asked it. If I get extra money, should I pay off my mortgage early or invest it instead? It sounds simple, but in 2025, with interest rates high, volatile markets, and inflation pressure, the right answer depends on so many factors. In this video, I'm going to break down how I analyze this, the numbers, the risk, real Canadian data, and examples so you can decide what works for you. I'm Thuc, your money guy. Let's go. Why this question matters more than ever. Interest rates have been rising across Canada. Mortgages locked in at low rates during the pandemic are now being renewed at much higher rates. The spread between what your mortgage costs and what the market might yield from investment is narrower than in past decades. As an example, one strategy, $5 a day extra toward mortgage, could save thousands in interest over the life of your loan. But depending on where equity markets are, those saved dollars might have earned more if invested. Plus, in Canada, many property owners are up for renewal in 2026, meaning their monthly payments could jump. So this decision now isn't abstract. It can materially affect your net worth. The core comparison, guaranteed return versus potential return. When you pay down a mortgage, every dollar you apply to principal is like earning a return equal to your mortgage interest rate, but risk-free, guaranteed. So if your mortgage rate is 5%, paying down principal effectively gives you a 5% return because you don't pay that interest. Compare that with investing. Historically, stock markets delivered 7 to 10% annual returns on average over long periods, but that's not guaranteed. You face down years, volatility, drawdowns. Here's how it plays out in different scenarios. If mortgage rate is 3 to 4%, investing might beat paying down your mortgage because markets often exceed that during bull runs. If mortgage rate is 6 to 7% or more, paying down might win because it's hard to reliably beat that after fees, taxes, and risk. If you're close to retirement or have low risk tolerance, the guaranteed reduction in debt might be more valuable to you psychologically and financially. Also consider tax implications in Canada. Mortgage interest on a principal resident is not tax deductible, so your return is fully realized. But investing in TFSAs, RRSPs, or tax advantage accounts may amplify the benefit of investing. A Canadian mortgage calculator shows that if you make a lump sum payment, you can save interest and shorten your amortization. Here's what most people don't think about: liquidity, flexibility, and mental stress. These can often tip the scales. The pros and cons of paying off mortgage early. Guaranteed savings. You will never pay interest on that principal again. Less debt burden, reduced financial stress, especially if income drops. More cash flow once mortgage is gone. Money frees up for investments or a life goal. Better margin for future rate hikes. Lower principal means less impact when interest rates rise. The cons and risks. Opportunity cost. That money could be invested elsewhere and possibly grow more. Reduced liquidity. Once you put money into your home, it's hard to get out. You'd have to refinance or sell. Prepayment penalties. Some mortgages limit how much you can prepay without penalty. Concentration risk. More wealth tied in real estate means less diversification. Missing out on tax advantage growth. Funds invested in RSPs and TFSAs grow tax-free or tax-defer. Canadian lenders advise ensuring you have an emergency fund, paying off higher interest debts first, and not sacrificing other financial goals. Pros and cons of investing in potential for higher returns. Historically, equities outpace mortgages rates over long term. Liquidity and flexibility. You can cash out investments more easily if needed. Compounding and reinvestment. Dividends, capital gains, reinvested returns accumulate over time more powerfully. Diversification. Not all your wealth in one asset. Cons and risks. Uncertainty. Markets can crash. Returns aren't guaranteed. Emotional stress. Watching investments drop can trigger bad decisions. Fees and taxes. Returns get eaten by fees, taxes, especially in taxable accounts. If mortgage rates rise, your debt becomes more expensive, which could offset gains from investing. Morningstar said sometime mortgage paydown promises a higher return. Your investment returns are low or risk is high. Also, RBC Wealth Management notes that often people do a mix. Invest some, pay down some, depending on their interest rate, tax bracket, and risk type. The smartest move might be somewhere in the middle, but only if you structure it right. Hybrid strategies and when to do both. You don't always have to pick one. Hybrid approaches let you balance safety and upside. Split strategy. For example, 50% toward mortgage and 50% into investments. Helps you grow but also reduce debt. Many Canadians on forums adopt a 50-50 approach. Debt recycling. This is advanced. As you pay down mortgage principal, borrow that equity to invest. This is riskier, but used by wealthier investors. Academic research calls this debt recycling. Tactical shifting depending on rates, market environment. When mortgage rates are very high, lean into paydown. When markets are strong and rates moderate, lean toward investing. Example, you have a 5% mortgage. You have extra $10,000. You put $5,000 to mortgage, saving guaranteed 5%, and invest $5,000 into index funds, hoping for 7 to 10% return. Over time, if market returns more than 5%, your invested side outpaces, but you've reduced debt regardless. Also, current Canadian policy changes. Starting August 1st, 2024, first-time homebuyers can amortize over 30 years instead of 25 for newly built homes, which reduces monthly payment stress. Personal factors to consider. This isn't purely math. Your personal situation matters heavily. Your mortgage rate, structure, fixed versus variable, renewal rate, your time horizon. Younger investors lean toward investing. Older ones might prefer debt freedom. Risk tolerance. If you fear market volatility, reducing debt may give better peace of mind. Other debts, credit card, car loan, usually pay off higher interest debt first. Liquidity and safety. You need emergency savings before locking everything into either path. Tax considerations. Your marginal tax rate, status of RSP, TFSA, etc. Edward Jones Canada notes that those with higher income may gain more by leveraging RSP deductions versus mortgage paydown. And many Canadian guides highlight that both mortgage repayment and investing net worth. The real question is which path gives you the bigger boost for your risk profile. So which do you pick? There's no one size fits all. The right decision depends on your rate, your risk, your goals, and your psychology. If you are conservative or close to retirement, paying down safer. If you have decades to ride volatility, investing may deliver more growth. Or split the approach. If this breakdown was helpful, hit like, subscribe, and drop a comment. Which path makes sense for you? Pay down or invest, and why? I'll read and respond to your replies. I'm Thuc, your money guy, helping you make smart financial decisions, not hype. Until next time.